welcome to a Senior Citizens Forum. I'm Janice Wood, your host, and you're going to find a Senior Citizens Forum on E360 TV. And the Senior Citizens Forum is being sponsored by Benefits for You 2 Insurance Services, where they specialize in Medicare supplemental plans, Medicare Advantage plans, and prescription drug plans. But today we're going to be talking about taxes, okay? And my guest is Lori Schnebelie, who I've known for many, I'm not going to say many years, but several years back. We were introduced by her neighbors at that time. And Lori became my client for health. And I love Lori's story because in reading her bio, I found out that she's gone to school in a couple of different countries. So welcome, Lori. And I see you've been to the University of London. You've been to San Jose State University. You got your MA in International Management from Virgin University in Brussels. Okay. And you got your MBA from Boston University, and you're now a certified IRS enrollment agent.
Yeah.
And so she's she's a fellow. She's done so much. She has started companies with her other fellows from her fellow program that she's been in. And she ended up doing taxes. And what I like, she lived in the Brussels area in the Netherlands for a while. Yeah. And she actually worked with people doing taxes there for the United States. So she's very informative and very educated in what she's doing. So, Lori, welcome to a Senior Citizens Forum.
Thanks.
And we have this show, as you know, is for seniors and their families. And a lot of the information their families can use to help their seniors, but maybe even for themselves. But getting ready to retire, being in retirement, the big question is, am I going to be taxed?
Of course.
Yeah. And nobody, it's not cookie cutter, as I've been finding out in the insurance world. If I'm dealing with one person, which is a one-person family, or 5 people, nothing is the same, and their needs are always different.
Right.
So for just as many people out there, there's just as many different types of needs that need to be met. So that's the same thing for preparing for your taxes for retirement and when you're in retirement, because some people could be single. Some people can be married. They could be married filing jointly or married filing separately. They can be head of household or non-head of household. There's a lot of combinations in just that. And what are we taxed on when we retire? So I have lots of subjects within the retirement taxation that we're going to discuss on this broadcast today. So let's get started. So if I'm getting ready to retire, what should I be looking at? And the first basic question is, am I going to be taxed because I'm retiring?
Of course, you're going to be taxed. So the IRS always wants their taxes. So taxation doesn't stop once you retire. So when a client comes to me, what I usually look at is, what are their sources of income and how is each different type of income taxed? And I like them to understand how their different sources of income are taxed now or when they're, and sometimes it then is going to change once they retire, right? And it can change once you hit 73, right? It can even change at the different stages of retirement. So of course you have your earned income if you keep working, and that's just taxed like you're used to, and that will continue to be taxed like you're used to. And your passive income, your interest, and your dividends will continue to be taxed as you're used to. You have your pension. If you start getting a pension, then that's also taxed. That's ordinary income, and it is going to incur income tax. Um, if you are going to start um, taking money out of a tax deferred account like an IRA or a 401k, where you put the money in pre tax, meaning you didn't pay your taxes on that before you put the money in. When you start taking those distributions out, those are also taxed. That's just considered regular income. And also your Social Security. If you start pulling Social Security, if your income is over a certain limit, which is pretty low, it'll start to be taxed as well. And then we can also look at the state implications. And the only item that is usually different with the state is the Social Security. A lot of states don't tax Social Security. So even if your income is over the federal limit, the state will still not tax it. There are certain states that will tax your Social Security. So depending on, California does not tax it. So depending on what state you're living in, we may need to consider if your Social Security is going to be taxable. So we can look at how it's taxed now, how it's going to be taxed when you start taking that source of income, and how it's going to be taxed going forward as you hit the different age cutoffs, 59 and a half, and then of course 73, 74, whatever, when the RMDs hit, which is always a big item in
So if you're
retirement.
using RMD, so why don't you tell us what RMD is for those that don't know?
Okay, so RMDs are your required minimum distributions. And these kick in once you hit around 73, 74. And this is the amount that the IRS requires you to withdraw from your 401k or your IRA. And these withdrawals are taxable. This forced withdrawal can create excess taxable income. If it's income that you don't really need in retirement, then it's taxable income. This additional taxable income then can push you into a higher tax bracket, could make your Social Security taxable. It can increase your Medicare Part B costs, right? By pushing you into this higher income level. So we do need to watch out for RMDs. If you don't have a lot of in your 401k, in your IRA, and the RMDs are going to be small, and it's just enough to help you cover your retirement, then RMDs are nothing to worry about. But that's definitely something that while you're in the while we're getting, as you're getting closer, I think usually once you hit about that 59 and a half, and we can start playing with your retirement accounts, this is when we like to look at your possible for RMDs, and if it's RMDs are going to become an issue for you in retirement.
Okay, you gave so much information right there. I mean, it's like overwhelming. So if I'm getting ready to retire and I'm, let's say, age 60, and I'm just collecting Social Security, am I going to get a lot of taxation and I have no savings, or I have no Roth IRAs, I have no, annuities, I don't have any of that kind of stuff? Am I going to have a lot of taxation? I'm just talking something very basic right now.
No, if you're just on Social Security and maybe getting a very small pension, or you have a little bit of money that you're withdrawing from a retirement account, you most likely won't be taxed then on your Social Security. That's usually very roughly under about 40K income per year. You probably won't be taxed on your Social Security. If you have interest, or you get some dividends or anything like that, though, that is taxable income, but probably also at that income level, you probably won't end up paying any tax. So that is a strategy that we use sometimes for people that we do try, in essence, to keep their taxable income low enough that they fall into that tax bracket of actually not really paying hardly any taxes, because all of they're under the limits for
So
taxation.
so let's just say I use myself as a single person there, but now let's say I'm a couple, okay? And I go into retirement, and I'm coming up with a completely different scenario for you. And I go into retirement and I still have teenage children, which is very possible because a lot of times people wait later in life to have family,
Yeah.
okay? But you still are ready for retirement. How is that going to affect the taxation?
Um, I think having kids these days doesn't affect your taxation that much because there is the child tax credit. There are some child tax credits, and there is the tax for other dependents. There is a credit for other dependents. Um, so if the child is still in university and you're paying for all of their living expenses, right? And they're a dependent. There is possibility of some child tax credits. There's a possibility of getting some credit for paying for their university, right?
Right.
So, but it's not going to affect your your retirement income or your retirement taxes in any way. Is kind of separate on your tax return, right?
Okay. Right. Okay. Now, my other question is because I'm going to use myself as an example. I retired,
Hmm.
I got a pension,
Yeah.
uh, I'm getting some Social Security, and I have two businesses going
Right.
and other stuff out there. Okay.
Right.
So that's going to get more complicated, I would think.
So it gets complicated, but only in that now we're looking at, again, when we're looking at your taxes, we're looking at your sources of income, right? So you are going to have business income. And so you're going to have some earned income, which is going to be taxed, and you're going to have Social Security taxes taken
Mhm.
out, et cetera, right? You're going to have some earned income, and you're going to have some pension income, which is going to be taxed. So you're going to have a lot of tax income, and probably you're going to have enough income that part of your Social Security is going to be taxed. So we would need to look at, is all of the, especially with your businesses, we'll have to look at um, you paying in estimated taxes, because you're not going to have enough taxes withheld. And generally, people don't have taxes withheld from their Social Security. And if your Social Security is then going to be taxed, so then we would look at probably doing some estimated taxes so that you don't pay a fine or a fee for underpaying your taxes when it comes to tax time. But
Yes.
yeah,
I know it's so complicated because
it,
I know here in the state of California, we also pay these different items get taxed also.
right. In
So
California, we generally follows the federal, taxation, right? And then everything flows onto your California return. And luckily, they let you take out your Social Security if you're retired. And then there's a California tax percentage. But California also allows, if you're retired and your income is lower, it also has I think it's a $280, the first $280 of your taxes they waive if you're lower income and you're retired, in your retirement age. So there are some credits in California you can get if you're lower
that's
income and you're retired. Yeah.
now I know as a retiree, okay, if I were to sell property, if I own property, okay, or I have businesses going and I sell them, how am I going to be taxed on that? Because I know property itself, you got the capital gains taxes. Okay. but now I'm trying to sell, let's just say I'm trying to sell a business,
So,
or I'm
okay,
trying
so
to,
that's very specific to your circumstance, but generally it's, it's basically like a capital gains tax. And
right.
we'd have to look at, how much profit you made on the sale, and if there's any hanging over of, are you going to be getting payments? So is it an installment? Did you make an installment agreement? Are they paying full out for the business? Right. So there's ways you can recognize the gain over years, or you can recognize the gain at one point, right? But that's generally going to be a capital gain, kind of like selling a house, right? I do see the selling of the house a lot with people heading into retirement. They sell the big family home and they buy something smaller. And in California, that sometimes is a surprise when they find that that they owe taxes on that, because you can get we can waive up to 500K of the profit, meaning we take what you purchased, we take what you sold the house for, and we subtract out what you purchased it for. So if you purchased your California home many years ago at 300K, and now you're selling it for over $1 million, which happens really regularly here in California, and you've just made 700K on the sale of your home. If you're married, we can only waive 500 of that, and you're going to pay capital gains tax on the other 200. So I do see that quite often with retirees that are downsizing, and they think that they can somehow take out the cost of their new place. The cost of your new place does not factor in to your taxes. It's how much did you make on selling your original home, right? That's what's being taxed is the
Okay.
profit. Yeah.
Yeah,
So
because that's a good question, because I know a lot of people are selling their homes now, and they think they can just take all that money and move it into another property and not be taxed. So, am I understanding you correctly? You are still going to be taxed on that capital gains, on
yes,
that money earned in that sale.
you are still going to be taxed on that. I do still look at that. There is an exclusion. So if you're married, you can make 500K in profit tax free. And if you're single, or like you're married filing separate, you only get 250K that you can make in profit tax free. So if you bought your home for 300K and you sell it for 350K and you only make 50K in profit, that's not going to be taxed because it's under the exclusion. But if you've made 700K, that's over the exclusion, and you're going to be taxed on the amount over that exclusion amount. And a lot of my retirees end up having to pay some tax on the sale of their original family home if they've owned that family home for a long time and it's really appreciated in value. Yeah.
Well, if you live in California, your property, especially if you bought it 30 years ago and you're
Yeah.
still there,
Yeah.
or even 15 years ago,
Yeah.
you're going to have capital gain.
Capital gains. Yep.
Capital gains. And so
Yeah.
it's interesting, because I always thought that if you took the money and you moved it over, you weren't going to be taxed. So you're telling me I went completely wrong.
Yep. That
Okay,
is
I'm going to give
taxed.
you a different scenario in this. Now, what if I own property in another state? Because I know a lot of people that own property in other states.
Yeah. It's for the federal government, it doesn't matter. It's the same calculation, right?
Okay.
On your federal tax return. So then you run into the state tax return where then sometimes the original, it depends on the state regulations, but sometimes the state where you sold the property, they want their portion of the taxes if there's a taxable amount, right? And sometimes it's the state that you're living in that wants the taxes. So we'd have to look at the state taxation of it, but somebody will want their taxes. Some state will want their taxes on that if it's taxable, if it's over the exclusion amount. Yeah.
Okay, because that to me is very. I mean, this has been very interesting because I was under the wrong. I
Yeah,
was
so
not.
there is the 1031 exchange, and you will hear a lot about that. People will talk about the 1031 exchange, and that's where you can exchange one property for another and not pay tax on the difference. But that is only for business properties like rental properties. So if you have one rental property and you sell it and you buy another rental property, then you can do this 1031 exchange, and you just exchange it and you tell the government, well, I'm not going to pay the taxes yet. I'm going to wait till I then sell the second property. So that is called a 1031 exchange, but that does not that cannot be including a home. That cannot be including your home. That is only business properties. Yeah.
Okay, I love this because I'm learning something I did not know.
Yeah.
Okay, because I always hear
Taxes
people
are
talking.
fun, right?
Yeah, it's very, it's very interesting because I'm always hearing people saying, I don't want to pay capital gains on my property. Okay.
Yeah.
And so I've got to buy something else or do something, but it doesn't matter. You're still going to pay the
If it's
capital gains.
If it's your home and it's over the exclusion, which in California oftentimes it is,
Yeah.
you will pay some capital gains. Yeah.
Well, thank you for letting me know how wrong I've been. Okay. Because I've been trying to tell my son if something happens to me and I die, you're going to have to pay taxes on the worth of the house at the time of death. And he
No,
goes, I don't think so. And I'm
you have
going,
to. No. Mm-mm.
no?
No, he won't have to, because when you pass the house on after you pass, then the recipient of the home, the inheritor of the home, he gets to own the home at the value of that day.
And that's what I was hoping. Yeah.
So
At
that's
that
when, but
day.
that's when you inherit. If you inherit the home, then
Right.
you get it at the value of that day. So it gets, they call it a stepped up basis. So then your son will own it at the value from the day you passed. So,
Okay. Yeah. I
so
just
then
wasn't
he turns
wording it the
around,
same way.
of course, and sells it right away. He's not making any profit on paper because he owns it at whatever it's valued at that moment.
At
So.
that day. Well, that's not bad. Okay.
Yeah. So that's the nice thing about then passing the home on, when, because the inheritor gets the stepped up value, and then they don't have to pay the capital gains.
Okay.
That's, yeah,
Now I know
that's
you've
planning.
lived, yeah, I know you've lived in other countries.
Yes.
Okay. All right. And you've done taxes for people that live in other countries that still pay income tax into the United States. Okay.
Yes.
So if
Mhm.
I'm a retiree and I want to move, let's say to, I don't know,
Mexico.
Mexico. Okay. Or I wanted to pick someplace in Europe. Okay.
Okay.
Okay. Say France.
Portugal
Okay.
is
Yeah.
the
Well,
popular one.
Portugal and Italy seem to be the places right now.
Yeah.
Okay. So, how are my taxes? I still have to pay taxes to the United States?
Yes. So you always, as a U.S. citizen or a US person, you always have to file a US tax return unless very specific circumstances, like your income is under that 12,000 14K standard deduction or whatever. So people are always surprised by that. And you move to Portugal, you need to sign up, you need to start paying your Portuguese taxes. You're a Portuguese tax resident, so they get first pass at you and you pay your Portuguese taxes. Then you come to me, we file your US return. We have to put all of the same income on your US return. But there are ways we can mitigate. Luckily, there's a tax agreement between Europe and the US. And we can often say, we use the foreign tax credit and we say, oh, we have all this income, but we already paid all of these Portuguese taxes on this income. And we just kind of subtract that out of the US taxes that you owe, right? So there are ways to mitigate your US taxes. And a lot of times with expats, they end up not paying any US tax because they paid enough foreign tax to cover it. But there's sometimes there's a little bit of a mismatch between the tax that you paid in the foreign country and then the tax that's owed in the US. They put the tax in different buckets. Earned income, passive income, gets complicated. And sometimes there's a little bit of a mix up between the buckets and you still owe a little something in the US. So, but we try hard to get it down to zero. There are ways.
Because I know my son lives in Brazil.
There we go.
Okay. And I think he said he didn't pay taxes in Brazil, but he's always concerned about his taxes
In the
in the
US,
United States.
there are certain countries that don't charge taxes or have very, very low income taxes. And then we can turn to what we call the foreign exclusion. And it just allows you to say to the US government, I earned this money overseas and I have reported it to the overseas government. So they're aware, but they're not taxing me at the same rate as the US. But we're just going to exclude that income from US taxation because it was earned overseas. It only works for earned income. So that only works if you have a job or you have a small business and you're earning income. Then you will then on your US return have to pay tax on any interest, dividends, or anything that's passive that you earn. And there's a limit, of course. So if you earn over the limit, I think it's around 120K, you can exclude. So there's ways to do it if you're from a country where the taxation is odd. There's definitely things we can do. International taxes get crazy complicated because we have to look at the tax treaties and the tax agreements. And definitely one of my specialties. So I love, because I find it interesting to dig through and find the solutions. But a lot of times expats end up not paying hardly any US tax. We can usually waive most of it using either the exclusion, saying it was earned overseas, or using a foreign tax credit. But we do need to file that US return, and you need to recognize that's something for even people living in the US. If you have foreign bank accounts or you have foreign investment accounts, which you shouldn't have, email me if you have any foreign investment accounts. That's a problem. If you have foreign bank accounts, then you need to be putting those on an FBAR form, and those need to go to the Treasury. And there's a $10,000 fine if they find that you have not been reporting your foreign bank accounts to the Treasury Department.
Okay. So let's say I moved to Brazil as a retiree.
Yeah.
And I have rental properties
in the US?
In the US. And I'm still earning money in the US.
Okay. So yeah, so we would look at, so you have to do a US return, put all of your rental income, etc., on all of your income on your US return. We would need to look at, is that foreign country going to require you to pay any taxes in that foreign country on that rental income? Some require it, some don't. And so can we match up the taxes? If not, then you'll have to pay your US tax on that rental income. But the one thing that you can't get out of is the state. If you have properties in California that you're renting out, California is going to want their tax on that California-based property. It doesn't matter that you're not living in California.
So that would be the same if you were in Illinois or Missouri.
Right. That's
and
correct.
You're living in a different country.
Yes. California is going to require you to file a non-resident return, but still then acknowledge your rental income and pay your California taxes because it is a California property, and pay your taxes. So state taxes don't go away when you move overseas if you have something in that state, right?
Okay.
If you kind of close everything up, if you have a home in a state, let's say you have a home in California, but you just leave it sitting there and you don't rent it out or anything, that doesn't then necessarily generate having to do a California return. It's only if you're earning income from that property in California.
Okay. I would love to be in that position, to have an empty house.
I know.
and,
So
and keeping up the property.
yeah, I do have clients that do it. I have a lot of clients that have moved to Mexico. That's a really
Yeah.
big place to retire because expenses are low. And I do usually recommend leave if you can when they it is often it has been a strategy the last few years to sell the big home, buy a smaller condo in your home state, and buy a condo, in Mexico. The living expenses in Mexico are small, and then you often still want to have some place to come back to see the grandkids and the family,
Yeah.
etc., in your home, and not have to constantly pay for a hotel or stay in the guest room or whatever. And so that has been a strategy. The taxation in Mexico is odd, but you can often get a visa to stay as a long-term visitor in Mexico, and then you're not actually paying any Mexico taxes, but then you're paying all your U.S. taxes like normal. You're just enjoying then a lower cost of living, and of course, beautiful sunshine and beaches, etc., in Mexico, right?
Mexico. So that means so whenever you go to any other country,
Yeah,
or I'm going to make it even more in the United States, because I know a lot of people who, especially on the East Coast,
yeah.
who will go down to Florida to get away from the snow. I don't know if they were successful over this last week. Okay. But, the snowbirds, as they like to call them,
Right,
or they go into the Bahamas or the Caribbean there,
right, right,
and then they go back in the summertime into the other part of the country. So,
right, right.
so you're still going to have to pay taxes in two different states, that sounds like.
No, you can, if you're only, like, let's say you're living in Connecticut, you
Right.
have a place in Connecticut, and let's say you have a vacation home in Florida, and you're only there, you know, December and January, right?
Mhm.
So then and Florida has no state taxes, so
Correct.
you're not going to have to file a return in Florida. But even if they did have state taxes, you generally wouldn't have to file a return in Florida. Your home base is Connecticut. It has to do with how long you're living there. If you have a place in Florida and then you're renting it out while you're not there, now you have a business in Florida, you're most likely going to need to file something in Florida, right?
Okay.
So I think the key is, are you earning income from that state? Then you will most likely have to file a state tax return. If you're just going there to stay in your vacation condo for a couple months and you're not really earning any income from that vacation condo, then probably you don't have to file in that state, right?
Yeah. I think that there's a lot to consider when you go to retire,
Yes.
and whatever your scenario is, because
Yeah.
every scenario is going to be
Different.
unique to those individuals. Okay. I mean, I know I have relatives that are always on a cruise,
Yeah.
but they own two different pieces of property.
Yeah. So then they need to unfortunately do the state returns in the states
Right.
where you have rental property, right? Yeah.
So it's yeah. So it's really interesting because you forget, or if you're driving around in your mobile home and you have a place that you call home.
Right.
Okay. I
Right.
mean, I run across so many people that they have a couple of homes, or now they're just renting.
Yeah. So then it's based on, where are you the majority of the time, right?
Right.
So and the states can get difficult if you don't pick a state. You should pick a state, right, and have that be your home. If you, let's say you're traveling all the time in your motor home, pick
Yeah.
a state to be your home. They're going to start looking at, where do you go to the doctor, where do you go to the dentist, where is the rest of your family located, etc., and then they'll
Well,
say
well, I know in the
that's your home.
I know in the Medicare world, if you're doing a lot of traveling, you have to be someplace 6 months, one day.
Yeah.
So that pretty much limits you for where you're going and what you're doing.
right. So you need to pick a home base, and that's where you have your doctors, etc. Right. So that's what I usually recommend people, especially people that move to Mexico or wherever. They still want to be able to use their Medicare. So
Right,
then I'm like, pick a home base in the U.S. and that's your use that mailing address,
right.
and tell everybody that when you come back to the U.S., that's your home base in the U.S.
That's your
So
home patient.
yeah,
As the insurance agent, I have to say you have to be there 6 months, 1 day.
there we go.
And if they do something else, I don't want to know.
You don't want to know.
I don't want to know. Okay.
I say that a lot with taxes. So, like,
Yeah.
if you do that, this will be the consequences. But that's just my advice. Otherwise, I don't want to know, right?
I I, I don't want to know. Okay. Please don't. I just
Gambling
don't want to
winnings are taxable.
know.
That's
Right.
I'm just gonna say that gambling winnings are taxable, right?
Right. Yes.
But they will if you don't get a 1099 form from wherever you were gambling, I just don't need to know about that, right?
Yeah.
So there's certain things that I just don't really want to know. So
Yeah.
ask me and then I'll tell you. And
Because
then
there's so I mean, we have to tell them
I have to tell
what
you the rule, right?
the rules, and I always want to use the word compliance because
Yeah,
we have to stay within those rules
right.
to keep our licenses.
Right, absolutely. I got to stay within the rules. But especially with the IRS, there is a large gray area, right? So a lot of times it's a discussion on how far into the gray area are you comfortable going. So I do often have discussions with clients about here's some options and what option are you comfortable with? And we can look at the consequences if the IRS decides they don't like our choice, right? So a lot of people think of taxes as being very straightforward, and in some ways they are, but there is actually a lot of gray area in the rules and regulations. And a lot of times I'm going on experience. There is not necessarily something in the code that says that's what you need to do. I'm going more on my experience and letters that I've seen come from the IRS. So we do often with taxes have discussions about comfort level, right?
Yeah, it is definitely comfort levels.
Right.
Yes. Yes. Okay. One of the other things now, what can seniors take as deductions? I know medical would be a big one.
So of course, you get an extra standard deduction, right? You get a higher standard deduction. So I usually look at that. If you want to itemize your deductions instead of taking the higher standard deduction, then you can look at taking medical expenses. Your medical expenses need to be pretty high usually to make an impact. But if you also can deduct the
Pre-
itemized deductions are your medical, your mortgage interest, the property taxes you're paying on your home, and any charitable contributions. And those four items we add up, and they need to be higher than that standard deduction to
Okay.
be usable, right? And that's where we run into trouble sometimes with the medical deductions is we can only take a certain percentage of them. It's not dollar for dollar. We can only take a certain percentage of them. We need to add them to your mortgage interest and your property tax and your charitable contributions, and that total needs to be more than your standard deduction, or we fall back on your standard deduction.
My standard. So if I'm looking at the medical part of it,
Yeah,
and I'm looking at, I know seniors have to pay for Part B, they have to pay a premium for Medicare Part B.
yeah,
And for 2024, that premium was $179.40. If you made, I want to say, if you were a single person making $85,000 or less,
yeah,
okay?
yeah.
And as a couple, it's more, it's more, okay?
Right, right.
But if I make over that $85,000, then I'm going to pay more. Can
Right.
I deduct that premium as part of my medical expense?
No.
No. Okay. I'm asking. Now, if I
If
say
you have we can do some we can look at deducting If you pay for long-term care insurance, there's if you pay for like long-term care insurance, we can deduct those some premiums. Of course, if you're self-employed and you're having to buy your own insurance because you're not on Medicare yet, my 59 year my 60 to 65 year olds who are still having to buy insurance, and you're self-employed, there's the self-employed healthcare deduction that we can do. But it's
Okay, let me go back because I am a Medicare.
yeah,
I'm knowledgeable in Medicare. Okay. Uh, Say I pick up a Medicare supplemental plan.
yeah,
Now I'm paying a premium, and that premium goes up every year because of age or increases because the supplemental plans are regulated by the state, each state.
yeah.
Okay. Those, as I said, those premiums go up. Along with, now you should have a prescription drug plan called Part D, and I'm paying a premium. Can those premiums be deducted?
Only if you're self-employed.
Only if you're okay.
Yeah.
Very interesting. Okay.
Yeah, it's because, and that's partially because Social Security is only at maximum 85% taxed. So they kind of feel like they're already giving you a little bit of a credit for those Part B, C, and whatever D payments by making part of
Right.
your Social Security never taxable. Part of your Social Security is never taxable. So, right. So it's only up to 85% of your Social Security is ever
Okay.
taxable.
That this is interesting because I know, and I always tell people, and you're one of my clients that I have on the Affordable Health Care Act. Okay. And I always say, they always ask me tax questions, and I always go talk to your your CPA, talk to your accountant, because
Yeah.
they get a tax credit if they're getting it through some form of an exchange.
Yeah. So when you do your taxes through an exchange, when you get your medical coverage through an exchange, we need to reconcile that on your tax return.
Yeah.
And you've told them how much income you have, and then you get a benefit based on that income level. And when we do your actual tax return, we have to reconcile that. And if your income was actually lower and you should have gotten more benefit, you can get that through your tax return. If your income was higher and you got too much benefit, you end up having to pay some of it back. So there is a reconciliation that takes place on your tax return when you are getting your insurance through the exchange.
Okay.
So we need that form. You get that form at the end of the year that shows the cost of your insurance and how much benefit you received. And we need to put that on your tax return. So that can be a good surprise or a nasty surprise, depending on how your income falls, right?
Right. Oh, definitely, definitely.
Yeah.
So, and then definitely people need to track if they are spending any expenditures on their medical to go along with those other three items that you talked about, the mortgage interest and those other items that they
Right.
need to watch. And again,
Right.
if
Yep,
you're
for the possible itemized deductions. So keep track of medical expenses, because if they end up being high, we might be able to flip to itemizing deductions and get you an extra big
right,
deduction. Right.
and if you need it. Well, this has been really interesting. I'm going to bring up information here on how to get a hold of Lori, which is really important to know. So let me bring up that her contact information. Um, Lori, do you do taxes throughout the United States? Because you were talking, you're doing it for people in Europe and that live in foreign countries.
Right.
So she's, as you can tell, she's extremely knowledgeable. She has a lot of education, and the tax laws change constantly on a yearly basis.
Yeah. It's very,
And
very fluid. So I keep very up to date, and I really like to help my clients keep up to date and be knowledgeable about their taxes and understand what they're signing when they sign their tax return. So hopefully, if anybody, I do know all the states, and of course international tax and retirement, and I love working with small businesses. So
Now I know,
email, email is really the best way to get me. If you,
yeah, and we have her information is posted up here. So please take her information down and how to contact her. You can also contact me. My information is also up there. Lori, my other question is, do you work with financial advisors at all?
I do work with other CPAs and financial advisors, and a lot of times it's working on mostly that's for higher income clients that are working on those mitigating those RMD taxations
Okay.
or possible taxation of what they're going to be leaving to their children, right? And then financial analysts or financial planners will ask me the tax to help with the tax implications of the plan that they're coming up with, because a lot of times the financial planners are more worried about making sure you have the income that you need, and they don't necessarily look at the taxation part of that. So I do work with financial planners and other CPAs, but I do some basic financial planning, but usually it's a heavy emphasis on minimizing your taxes in the different phases, right? So
Okay. Very good.
yeah,
Okay. And as again, I said, here's Lori's information. She's available if you uh, pay taxes in the United States. All that information should be coming in the mail
yep,
on anything that you've earned and your bank accounts, your whatever your earnings are.
yep.
All that stuff. I'm
Gather all those 1099s and your W-2s,
right.
and January 27th, the IRS opens for the new tax season, and it's all gets started. And by April 15th, you should be, if not getting your return in, getting your extension in,
Your
right?
expenses in. So just real quick, you work with clients remotely because I know so much is done remotely. So that's and a lot of seniors don't realize that. So if you're living in New Hampshire,
Yeah,
you can definitely talk to Lori. She can work with you with
yeah.
that. Well, thank you so much, Lori, for being on a senior citizens forum.
Thanks,
I
Janice, for having me. That was great.
You've had you've provided us with a wealth of information, and I hope everybody has enjoyed our show today. I will see everybody back next week. I hope you hope had a all had a wonderful week. Thank you, and have fun with those taxes. Don't make it too stressful for you.
Thanks.
Thank you.